Welcome back to the Ripple Crypto Trends in Business report for 2023. We are on page 35 and we hope to finish the end of the report today. So let's get started. This part is called custody. Crypto custody is how companies safely and securely store their tokenized assets. There are two options, self or managed custody. Self-custody for corporate entities is when an asset manager, e.g. a pension fund or a fund manager like BlackRock or Fidelity, or a corporation, takes on the role of a custodian to directly manage the sub-custodians in the markets and jurisdictions where they have a trading relationship. The alternative to the self-custody of tokenized assets is to appoint a global custodian bank. Managed custody is when a third party holds and manages a customer's tokenized assets and private keys on their behalf, and is responsible for their safekeeping. This includes wallet management services that facilitate the tracking, valuation, and servicing of the tokenized assets held. With self-custody, individuals or companies protect and control their own assets without having to rely on a third-party intermediary. This provides complete autonomy over their funds, increased privacy and security. Private keys aren't stored on a central server. Financial inclusion for those that are unbanked and don't otherwise have access to basic financial services, and a more decentralized solution. The main drawbacks of self-custody are the amount of responsibility, complexity, and technical savvy required in order to safeguard assets and information. Some self-custody wallets may also offer limited capabilities and functionality. Managed custody solutions help alleviate the burden on a business to worry about private key management. And because permissions to move or transfer assets are not limited to a single individual or entity, managed custody and wallets provide customers with secure and convenient access to digital assets. With managed custody, customers can take advantage of the provider's regulatory compliance expertise, insurance against loss or theft, and technical resources. On the flip side, a third-party custody solution could mean potential delays or hidden fees, possible platform failures, or other factors that could be outside the asset owner's control. Current state. There is no right solution when it comes to crypto custody, but rather a case of determining which model best suits the needs of each customer. In the wake of FTX and other crypto firm collapses, it's become more important than ever for banks, crypto fintechs, and others to have the appropriate custody solution in place that meets their business needs. As part of our research, we wanted to gain a better pulse on the current state of crypto custody, especially in light of recent market events, and paint a clear picture of the landscape. While a greater proportion of respondents at financial institutions compared to their enterprise counterparts currently use crypto custody in their business, in general, across all respondents, we found that a total of 35% are currently using a custody solution, and 54% plan to within the next 3 years. Additionally, most companies currently are planning to use crypto custody will do so via a managed custody approach outsourced to a third party. But why is that? Why are the primary benefits and reasons that would drive organizations to choose a managed custody solution? Increased security and resilience to protect digital assets and reduce risk, and up-to-date best-in-class technology were among the primary drivers. Though security was the top reason across all respondents in all geos, it was particularly important among the enterprise audience. Additional reasons why enterprises might look to manage solutions include improved operational efficiency, reduced operating costs, and the ability to future-proof their technology and processes to enable them to take advantage of opportunities in an evolving space. And then there was a little box here. Most finance decision makers plan to use managed custody in the next 3 years. 35% said they currently use managed custody. 54% plan to use it in the next 3 years. 7% do not plan to use it in the next 3 years, and 4% are not sure. We go on. Regardless of whether enterprises use self or managed custody, both approaches typically leverage a third-party software provider's technology. However, managed custody solutions tend to be regulated. So even though a managed custody provider might use the same technology or infrastructure provider, they do so in a regulated, licensed manner on behalf of their customers. Key considerations: widespread use of cryptocurrency for payments and demand more generally for digital assets are two of the most important considerations for financial institutions providing custody services to their customers. In order for there to be a market for managed custody providers and B2B to C solutions, there needs to be a more widespread demand and use of digital assets that require custody. In other words, this can be interpreted as supply and demand, where use and adoption of digital assets begets further need and use of custody solutions. While digital asset appreciation can be difficult to predict, as recent events have illustrated, certain asset-backed stablecoins have been designed to protect holders from price swings. Because they are pegged to a national currency, their value largely remains stable. Therefore, if the value of a certain cryptocurrency drops or swings dramatically, holders can move their funds into stable coins to protect their portfolio. Other considerations that are top of mind for financial institutions include widespread consumer demand for cryptocurrencies and other digital assets in the same vein as widespread use, demand from a top 50 institutional client of the utmost importance for those in blockchain cryptocurrency roles, as well as regulatory clarity. As with crypto and blockchain in general, the regulatory landscape for custody is still fragmented and unclear across jurisdictions. In the U.S. alone, custody requirements and regulations can vary not only at the federal level, but also at the state level. While historically the global custody and regulatory landscape has been patchwork at best, progress is being made. European Union lawmakers recently approved MiCA, Markets in Crypto Act, the first comprehensive framework for global crypto regulation. And then there's a box, considerations for financial institutions offering custody solutions to customers. 46% say cryptocurrency will be widely used for payments. 43% cryptocurrency asset appreciation. 39% of financial institutions will use it for widespread consumer demand for cryptocurrencies. 37% are offering it for regulatory clarity, and 35% are considering using it for demand from a top 50 institutional client. Managed custody solutions in particular can and should be regulated in order to operate in the best interest of their customers, but also to help alleviate challenges associated with making cross-border payments and otherwise conducting business internationally. Encouragingly, some of the financial industry's most reputed and regulated players share the same sentiment. BNY Mellon offers digital asset custody for asset managers in the U.S. More recently, NASDAQ announced their plan to launch cryptocurrency custody services for Bitcoin and Ethereum by the end of Q2 2023, signaling the stock exchange's first step toward a larger digital asset initiative. And the likes of BNP Paribas, Union Bank in the Philippines, and Societe Generale are investing in digital asset infrastructure that enables them to build and manage digital products on various blockchain ledgers and realize new operating efficiencies in the management of cryptocurrencies and digital assets. Okay, that paragraph right there is worth its weight in gold because it basically says that future financial institutions, the largest international financial institutions, are all planning to use cryptocurrency. So anyone who says crypto is a scam or believes this whole FTX debacle is representative of all crypto is just plain wrong, according to that paragraph right there. Institutional grade custody solutions are the secure middleware that can integrate with a bank's core banking tech stack and other in-house systems, for example AML, enabling them to grow and scale. Crypto liquidity. Tokenizing different asset classes using DeFi protocols to move, manage, and transact with those tokens, and custodying those tokens to keep them safe and secure are relatively straightforward on a small scale, e.g. for an individual trading NFTs. But for companies looking to grow and scale an enterprise-grade crypto-enabled solution, the illiquid nature of these types of tokens becomes an issue. Tokens are subject to network effects. The more the token scales and the more adoption it receives, the more utility of the technology is realized by the user. But the current state of today's fragmented market reduces liquidity. Broadly speaking, liquidity indicates the ease and speed with which you can convert a digital asset into cash or other digital assets, and whether this can be achieved without the asset's value suffering. Crypto liquidity can be impacted by a number of different factors, including the number of users on a platform, price volatility, trading volume, and market efficiency. For businesses leveraging crypto for operational purposes, liquidity can enable growth, protect against risk, and help facilitate core treasury functions. As a business scales, it must maintain proportionally higher levels of liquidity to optimize operations and sustain growth. To satisfy this demand and source liquidity at optimized pricing, all while trying to avoid disruptions, businesses will often tap multiple exchanges or marketplaces to build liquidity through currency trading and payments. Yet, each liquidity venue is dynamic and different rules of engagement and constantly changing levels of liquidity, volume, and quality. The complexity of managing digital assets across all these venues can become onerous. Adding crypto into this liquidity mix can provide important advantages, but brings additional management challenges. So why might financial institutions and enterprises want to hold crypto on their balance sheets in the first place? Companies that leverage crypto may realize a whole host of benefits, including access to new asset classes, immutable and transparent data, increased liquidity, and faster settlement. And as cash usage declines, they are also able to meet growing consumer demand for crypto. For example, employees who prefer to be paid in crypto, fiat, or a combination of the two, or customers who want to purchase goods or services using crypto. Use of digital asset services. Double-clicking on financial institutions, our study showed that the majority of global respondents are either already using, currently exploiting, or interested in exploring the use of digital asset services. And those in institutional banking or payments related roles seem to be the primary drivers. And then it says 3/4 of financial institutions are likely to explore digital services in the next 3 years. According to those not already using or exploring digital asset services, over 3/4 are either somewhat or very likely to do so in the next 3 years. This is very promising for the industry, reaffirming overall sentiment and attitudes toward crypto, the belief that the technology is here to stay, and the financial institutions are gearing up. As the figure below shows, these same respondents also anticipate, or perhaps already are, using digital asset services across a variety of payments-related use cases, buying, selling, and holding crypto. Looking more closely at the enterprise landscape, we see that those finance leaders are particularly interested in holding cryptocurrency to make payments and for use as a hedge against inflation. The latter ranked highest among respondents in LATAM, which is reflective of the region's recent and perhaps historical challenges with high inflation and interest rates. When comparing these results to last year's, the reasons to hold crypto have remained largely the same with one exception. While making payments and inflation hedge were in the top 3 last year, respondents had also included as an asset to lend/collateral for borrowing. This year, hedge against foreign currency exchange risk edged that reason out of the top 3 box. This is in large part driven by macroeconomic factors like high interest rates and inflation, or in the U.S. where there are significant slowdowns in lending and borrowing activities as evidenced in the housing market as one example. As more enterprises adopt crypto and more assets are tokenized, it is increasingly critical that businesses can seamlessly bridge the new world of digital assets with the traditional world of fiat. Whether it's converting Bitcoin to fiat, managing a crypto position, or accessing last-mile payout rails, there is demand for interoperability between financial systems. But without a ton of overhead, large technical teams, and crypto savvy, it can be extremely difficult to try and implement an in-house crypto liquidity solution. When it comes to build versus buy, 72% of digital asset investors would prefer an integrated provider. For those companies, partnering with a third-party solution like Ripple's Liquidity Hub helps to remove those barriers to entry. Then there's a box that says additional benefits of optimized crypto liquidity, some bullet points: redundancy, meeting customer demand, reduced operational overhead and reduced pre-funding. Then there's another box, use cases for digital asset services. 25% consumer to business payments, 21% cross-border payments acceptance issuance, 18% consumer peer-to-peer payments, 15% treasury portfolio management, 14% vendor supplier payments, and 6% for government to citizen payments. While many non-bank financial institutions like fintechs and non-banks help both financial institutions and Web3 organizations integrate and become crypto-friendly, they too still rely on traditional payment rails and networks, ultimately sacrificing payments cost and speed. Leveraging a truly crypto-native solution can automate the crypto input in-out process, integrate global crypto on-off ramps, and facilitate easier crypto deposits and withdrawals. This not only helps diversify portfolios and facilitate faster payments, but also expands revenue sources and opens up access to 24/7, 365 markets. Then they have a little box, top reason to hold cryptocurrency. 50% say as a reason for making payments, 44% as a hedge against inflation, 39% hedge against foreign exchange risk, 35% hedge against macroeconomic factors, and 32% as collateral for borrowing. Then there's another box. SuperMojo case study. SuperMojo is a cutting-edge tech platform that is revolutionizing the world of non-fungible tokens. The core mission centers around driving greater accessibility of NFTs in order to make interacting with brands and creators easier for consumers. SuperMojo has developed strategic partnerships with creators, brands, digital asset marketplaces, and storefronts to offer simplified card on-ramps and custody solutions with embedded utility. Ripple Liquidity Hub plays a crucial role in supporting SuperMojo with its internal treasury operations by sourcing ETH on demand for customers purchasing NFTs. The impact of Liquidity Hub on SuperMojo's business operations is sizable. The company no longer needs to hold pre-funded capital positions with multiple liquidity venues. Liquidity Hub acts as a capital management or hedging solution to minimize risk exposure with other venues. And it says in quotes, there are some instant benefits we get from Liquidity Hub, programmatic upfront pricing that powers our acquisition of ETH NFTs instantaneously and on demand. That is a big order that doesn't really exist from other platforms that we've tried before. And that was Craig DeWitt, head of product and engineering at SuperMojo. And here's the close of this chapter. There are many aspects to managing digital value, none of them simple. But with the right underlying technology, partner, and solution in place, financial institutions and enterprises stand to gain a myriad advantages by adopting DeFi protocols and practices. As highlighted in this section, it's clear that finance leaders across the globe are taking note, and many are already well on their way to integrating or exploring DeFi and digital asset services in their organizations, be it for borrowing and lending, accepting crypto payouts, or to hedge against inflation and FX risk. There are many areas where institutional DeFi can enable organizational excellence and better customer experience. Arguably, this is the area where the industry at large has the most to learn, both from a technical perspective in areas like decentralized identity, ZK proofs, and crypto custody, but also from a regulatory perspective. As we move on to the next section, we will continue to see the common thread of the need for regulatory clarity woven throughout. Yeah, well, we understand that, Ripple. Okay, we're on page 42 now, and this section is called Move, M-O-V-E. Finding new, innovative ways to move value, i.e. make payments that are faster, more transparent, secure, and reliable is core to the concept of the Internet of Value. Indeed, it's what we at Ripple have advocated for the last decade. And while some of these concepts were nascent when we first set out, they've now become commonplace and part of the narrative among financial leaders at banks, PSPs, and fintechs, at businesses and corporations of all sizes, as well as central banks exploring CBDCs for domestic and cross-border payments. In fact, major finance players are placing big bets on blockchain technology. Earlier this year, MasterCard announced over 2 billion tokenized transactions made per month, a 38% increase year over year. The company also launched over 30 crypto-friendly debit and credit cards and digital wallets in 2022. And Goldman Sachs used crypto and blockchain technology for a €1 billion bond sale that closed in under a minute as opposed to the typical 5-day settlement time, an example of enabling blockchain-driven payments for asset purchases. Enterprise use of crypto is also continuing to expand and evolve with companies like PayPal, Stripe, WorldPay, AT&T, Burger King, and Overstock now accepting cryptocurrency as a form of payment. Wow, I didn't know that. All those companies accepting crypto as a form of payment. PayPal, Stripe, WorldPay, AT&T, Burger King, and Overstock. The volume of value and methods by which that value is moved around the world is also constantly evolving. In general, global payments volumes are on the rise, primarily driven by APAC. Revenues increased 11% in 2021, while overall electronic payments transactions see a growth of 19% in the same year in a post-pandemic world, trends including declining cash usage and a massive uptick in e-commerce sales are prominent. As businesses and their customers pivoted, e-commerce experienced 17% growth in 2021, primarily driven by China, and cash usage fell by 20% globally in 2020. Further, digital payments methods like instant and mobile payments and account-to-account A2A transfers accounted for 29% of global revenue in 2021. It's important to remember that these are not necessarily new innovations. Many regions and countries like Brazil, with its open banking system, PIX, the European Payment Council's SEPA program, Vodafone's mobile money transfer service, M-Pesa, in Africa, and WeChat Pay and Alibaba's Alipay in China, have already invested in modern instant payment systems and have been leading the way for some time now, more than 20 years in the case of Alipay. The next wave of innovation for digital payments methods powered by blockchain and crypto technology will not necessarily be focused on replacing these systems, but rather identifying ways to improve them, with a shift toward building value-added applications and services underpinned by those more incumbent rails. Be it with faster, more cost-effective payments enabling even greater financial inclusion in historically underserved markets, or protecting privacy while simultaneously providing greater transparency over the transaction process, we can likely expect an uptick in adoption across a variety of use cases. And it says in bold print, the next wave of innovation for digital payments methods powered by blockchain and crypto technology will not necessarily be focused on replacing these systems, but rather identifying ways to improve them. Then we have a whole page chart here. Crypto and digital assets for payments, current adoption and forward trends. Summary of key findings. Global finance leaders see use as a payment method as the biggest accelerator for the adoption of crypto and digital assets. That's 44%. The same amount see use as a payment method as the biggest accelerator for the adoption of crypto. Top 3 use cases for both financial institutions and enterprises using crypto payments. 53% accepting payment in the form of crypto, 52% enabling customers to make crypto payments, 47% making cross-border payments in crypto. Adding value to cross-border payments, 58% of global payments leaders see faster payments as the number one value prop for incorporating crypto into cross-border payments. 58% of global payments leaders say faster payments. 50% of global treasury leaders say cost savings. Top pain points that crypto can address for: payments expensive payment structures, 32%. That doesn't sound right. Treasury time consuming middleware integrations into payments flows, 38%. Protection from price volatility is a must. Number one biggest perceived risk of using crypto for payments. 27% said price volatility. 20% said unclear regulation. 20% said highly restrictive regulation. 20% said unsecure technology, and 14% said bad actors. Payments use cases today and tomorrow. Over 90% of global payments professionals believe crypto and blockchain will have a significant or massive impact on finance and businesses in the next 3 years. But that's what's driving this anticipated adoption. What are the biggest accelerators? We asked, and here's what we found out. Nearly half of all respondents, 44%, selected use as a payment method, as the key accelerator, particularly in APAC and among those in institutional banking payments and treasury. Further, almost the same amount state that their organization is extremely willing to enable customers to pay with crypto, although it's worth noting that willingness was substantially stronger among financial institutions, 51%, than enterprises, 35%. This makes sense given the aforementioned institutional adoption of crypto and the robust payments infrastructure they already have at their disposal. Surprisingly, reputation as a key driver of adoption did not rank as high as we thought it would. Where things get really interesting is breaking this down by role type. A greater percentage of finance leaders in digital transformation, blockchain/cryptocurrency, or innovation roles think regulation will be an accelerator to crypto adoption. Compared to their more traditional counterparts, those in institutional banking, payments, capital markets, treasury, and compliance. Those who are championing these technologies at their organizations undoubtedly know the importance of clear and favorable regulations in order for crypto to realize its full potential. And while more traditional financial players have historically not been advocates of more regulation, it will be interesting to see if and how that changes in light of the collapse of major commercial banks like SVB and Credit Suisse. 90+% of global payments professionals believe crypto and blockchain will have a significant or massive impact on finance and businesses in the next 3 years. And there's another little box, accelerators for crypto adoption. 44% say use as a payment method. 41% say crypto asset value is an accelerator for crypto adoption. 34% say growing institutional enterprise adoption. 30% clear and favorable regulation, 29% use related to NFTs, 29% use as a hedge against inflation, 26% accounting standards related to asset type, 25% use in corporate treasuries, 24% use in borrowing and lending. More enterprise respondents plan to use crypto for payments in the future compared to their financial institutional counterparts. Of those that do currently use crypto for payments, the majority typically do so by moving funds directly from a digital wallet they manage as opposed to via an aggregator's or payment service provider's digital wallet. This was true across all role types, with the exception of compliance professionals, who more often enable customers to pay with crypto via a PSP, e.g. PayPal, Stripe, Square, etc. This makes sense since PSPs are regulated and therefore are already in compliance with relevant regulatory requirements, which means less burden on internal compliance teams. For those that plan to leverage crypto for payments in the future, over half plan to do so in order to accept payment in the form of crypto and to enable customers to make crypto payments. Interestingly, the top 4 use cases are especially important among enterprise respondents. And since we know that more of these companies say they have future plans to use crypto for payments compared to financial institutions, it seems we can expect to see quite a bit of growth and adoption among that sector in the near future. This is a positive indicator of broader business adoption of crypto, in large part driven by e-commerce companies. Since the COVID-19 pandemic, over 1/4 of all online businesses are planning to enable customers to pay with crypto by 2025. Okay, that's a powerful statistic. Since the pandemic, over 1/4 of all online businesses are planning to enable customers to pay with crypto by 2025. And another little box, crypto payments use cases. 53% say accepting payments in the form of crypto, 52% enabling customers to make crypto payments, 47% making cross-border payments in crypto, 37% making domestic payments in crypto, 32% accepting donations in the form of crypto, and 31% say their use cases for payroll and distribution. Double-clicking on cross-border payments. It's no secret that payments today are costly. In other recent research we conducted, cost savings was cited among global payments leaders as crypto's primary benefit. With crypto, fees incurred by merchants are less than 1% compared with those of traditional fiat, which typically hover around 3.5%. And when it comes to cross-border payments specifically, Juniper Research estimates up to a tremendous $10 billion in savings for banks using blockchain technology for cross-border transactions, while a recent Checkout.com report found that 77% of merchants that accept crypto as a payment method also experience a subsequent increase in cross-border sales. An average of 14% of traditional global cross-border transactions result in added fees incurred by the correspondent banking partner. This is largely due to high payment failure rates where there is still a lot of room for human error, i.e., manual processes, data inaccuracy, and delays. Indeed, the high cost of traditional cross-border transactions extends beyond financial institutions to enterprises as well. In our research, over half of enterprise respondents cited cost of payments as their biggest cross-border payments challenge, with high interest rates another cost-related pain point, a close second at 49%. And then it says $10 billion in savings for banks using blockchain technology for cross-border transactions. 52% of enterprise finance leaders cite cost of payments as their biggest cross-border payments challenge. Breaking this down by region, we see that enterprises in North America, EMEA, and APAC are more burdened by the cost of payments, whereas for those in MENA and LATAM, high interest rates cause more headaches for their cross-border payments business. Given the latter region's recent economic struggles with soaring inflation rates, these findings make sense and are something payment providers servicing that region should keep top of mind. Traditional cross-border payments generally require currency conversions, and high interest rates contribute to exchange rate volatility. Fluctuations in exchange rates lead to unpredictable costs for businesses. This FX exposure can result in banks charging enterprise customers with new or higher fees to compensate for increased transaction costs incurred by the higher interest rates. Then they have a box with cross-border payments challenges by region. And they have each region broken down and under cost of payments, high interest rates, payment settlement speed, lack of access to global payments networks corridors, raising capital, pre-funding requirements, lack of liquidity, and payment errors. Depending on jurisdiction, regulations, and currencies used, other reasons why high interest rates might be a pain point for cross-border payments could include reduced liquidity. High interest rates can restrict the availability of credit and reduce overall liquidity in the financial system, which in turn makes it more difficult for businesses to access funding for crypto for cross-border payments. Cost of borrowing. When interest rates are high, it becomes more expensive for businesses to borrow money, which impacts the cost of financing cross-border transactions and makes it more costly to send and receive funds internationally. Additionally, these higher borrowing costs may result in enterprises being less inclined to expand their operations in new markets or engage in cross-border trade. These are areas where crypto and blockchain technology can help solve for inefficiencies, and it appears global payments leaders are aware. We asked payments and treasury professionals at financial institutions and enterprises which payments-related pain points they believe crypto can help solve for their business. Results were relatively evenly distributed across the options provided, which is perhaps the biggest takeaway here. We can glean that the majority of financial institutions and enterprises around the world are in fact dealing with any number of pain points when it comes to payments, and that generally speaking, they believe crypto can help solve all of them in one way or another. That's powerful. Okay, and then they have a box that reflects everything I just said. Top pain points in crypto. 33% can solve time-consuming middleware integrations into payment flows. 32% said expensive payment structures. Another pain point solved, 28% lack of transparency, 27% difficulty managing multiple assets and cryptocurrencies, 27% fraud, 27% payment error rates, 26% long settlement times, 25% poor data security, 21% required pre-funding of destination accounts, 18% poor data quality. Where we saw the most variance was among respondents in MENA, 43%, who are particularly enthusiastic on crypto's ability to solve time-consuming middleware integrations into payment flows, treasury management, ERP systems, etc. Over half of payments and treasury leaders agree that faster payment settlement times and cost savings are the biggest value propositions for incorporating crypto into their cross-border payments business. When we break these down by role type, we learn that those in treasury favor cost savings, whereas payments professionals care more about faster payment settlement times. This was true regardless of level of experience with crypto and across all regions with the exception of LATAM. Number one value prop for incorporating crypto and cross-border payments. Treasury professionals say cost savings 58%, faster payment settlement times 48%, payment professionals say cost savings 51%, and faster payment times 58%. Cross-border payment challenges, cost of payments 52%, high interest rates 49%, payment settlement period 44%, lack of access to global payment network, payment corridors 33%, raising capital pre-funding requirements 30%, lack of liquidity 27%, payment errors 26%. Digital payment transactions experienced significant growth over the past few years. 2018 and 2021, the number of non-cash retail payment transactions grew 13% compounded annual growth rate. This pandemic-era shift toward e-commerce turned even small and medium-sized enterprises into global businesses. Small and medium enterprises, SMEs. SMEs, which typically already operate on razor-thin margins, are heavily impacted by the global supply chain, have an increasing demand for cross-border payment solutions, but have long been underserved by traditional financial rails. The opportunity is particularly vast in emerging markets, where there is over $100 billion in potential SME cross-border payments revenue. As the first exclusive, okay, this is a little box here, that's almost a page long. Cross-border payments case study. As the first exclusive foreign exchange bank approved and regulated by the Central Bank of Brazil, Travelex Group is a cornerstone financial institution that enables global payment flows for consumers and businesses across the country. Travelex has partnered with Ripple to support crypto-enabled payments and provide faster, more affordable transactions for their customers. With Ripple's payment solution, Travelex can settle global transactions in a matter of seconds. Not only do their customers gain the advantage of speed, but also protection from fluctuations in FX rates that may occur using traditional payment rails. Another core feature of the partnership was the opportunity to expand into new markets and cement their position as a leading institution throughout Latin America. The benefit of working with Ripple in South America is very important to us. We want to expand, and Ripple's knowledge of surrounding markets allows us to more easily enter into and work in these countries, said João Manuel Campanelli Freitas, Travelex Chief Business Development Officer. But in order to tap into this opportunity, payments providers must prioritize a seamless solution. SMEs that are working with fewer resources, human, financial, technical, need things to be easy. They don't have the teams, time, or capital required to integrate multiple systems into their tech stack or onboard into 2, 3, 4 different tools. In fact, ease of use was the number one most cited requirement of organizations of all type to enable their customers to pay with crypto. Digging into the data, ease of use stayed at the top of the ranks across financial institutions, enterprises, role types, regions, and crypto and non-crypto users. However, there was one area where it was outranked by another requirement. Treasury respondents specifically value no-cost fluctuations above all else. Transforming Treasury. It's no secret that today's current global payments landscape is slow, costly, fragmented, and archaic, and the majority of global enterprises still use bank transfers, e.g. wire, ACH, and manual processes to manage and move money across borders via their primary banking partner. Therefore, it's also no surprise that financial institutions and enterprises alike are catching on, taking notes of the advantages afforded by crypto and how the technology is driving everyday business value for enterprises and their customers around the world. And it says institutional requirements to enable customers to pay with crypto. 70% ease of use, 60% no security risk, 58% no cost fluctuations, 57% predictable fiat conversion costs, and 56% no volatility risk. One area where this is becoming increasingly prevalent is with internal treasury. Managing various fiat accounts in every country of operation dramatically increases the complexity of treasury management, operations, and liquidity. In fact, in 2021, McKinsey estimated $3.5 billion in annual global corporate spend to solve treasuries and liquidity issues. Compounding this is the fact that companies have to pre-fund foreign destination accounts, which ultimately traps working capital in nostro and vostro accounts that could otherwise be put to use elsewhere. Blockchain and crypto can help solve these challenges by eliminating the need to pre-fund accounts and enable faster real-time settlement, both of which provide greater access to liquidity. With improved tracking and transparency over the flow of funds without tying up working capital, and access to always-on 24/7 365 markets that never close, treasurers aren't confined to traditional banking hours, nor do they need to wait days or even weeks for payments to settle. Faster cross-border payments, even into notoriously complex corridors like India, Mexico, and Southeast Asia that don't require pre-funding accounts, can enable treasury teams to improve cash flow planning, enhance commercial terms, help suppliers factor their receivables, expand into new markets, and more. Our study complements these sentiments. The vast majority of Treasury respondents believe crypto will have a significant or massive impact on finance, 88%, and business, 84%, in the next 3 years. Further, half say that their organization is extremely willing to enable customers to pay with crypto. And when asked about the likelihood of their organizations adopting CBDCs, stablecoins, or cryptocurrency in the next 3 years, 60% said very likely. Unlike their payments counterparts, we learned that treasurers, particularly those in LATAM, care more about cost savings as a key value proposition for incorporating crypto into their cross-border payments businesses. For corporate treasurers that need to move funds into and out of complex corridors like Mexico, India, and Southeast Asia, this task becomes exponentially more challenging due to the lack of FX and capital flow. Even traditional banking partners often find it difficult to provide the capital and funding needed for companies to pay employees, vendors, suppliers, or collect revenue from these markets. Treasury operations, as we know them today, lack real-time, automated, transparent payments, causing pain points associated with speed, security, and efficiency for both employees and customers. It says $3.5 billion annual global corporate spend to solve treasury and liquidity issues. There's a little box here. Crypto offers new ways to enhance traditional treasury management, including, and some bullet points, simple, real-time, secure money transfers, better control over capital, manage risks and opportunities of digital assets, reach a new clientele, and grow the volume of sales transactions. Despite these advantages, many treasurers are still averse to holding crypto, in large part due to price volatility, 50%. Followed by highly restrictive regulation, 44%, as our research indicates. So, those treasurers who want to realize the benefits afforded by the technology and transform treasury operations while keeping crypto off the corporate balance sheet require a different entry point into the use of digital assets, i.e., through a trusted third-party provider. Then there's a box here. The third-party vendor manages the technical risk, compliance, and controls issues on behalf of the customer. The third-party vendor accepts or makes payments in crypto through fiat conversions, enabling a hands-off approach for the customer. Then we have another box, perceived risks of using crypto for payments. Price volatility, 50%, unclear regulation, 42%, highly restrictive regulation, 41%, unsecure technology, 39%, bad actors, 29%. Barriers to adoption. Clearly, crypto affords a ton of opportunity, but it doesn't come without challenges. As with any burgeoning technology, there are certain levels of risk that need to be weighed. And of course, where the flow of funds is involved, it's to be expected that organizations have their hesitancies. We wanted to find out what these were among both financial institutions and enterprises to get a pulse on what might be stopping these businesses from using crypto for payments. Here's what we found. In total, across all respondents, price volatility ranked as the number one risk. This is true across financial institutions, enterprises, regions, with the exception of MENA, where respondents ranked highly restrictive regulations slightly higher. And those in roles related to digital transformation, institutional banking, treasury, compliance, and innovation. Interestingly, this is also true for respondents regardless of whether or not their organization already has a cryptocurrency solution planned or in production. This is likely reflective of recent market turmoil and the ebb and flows in the price and market caps of various cryptocurrencies. There are ways that enterprise-grade institutional-level solutions can protect customers from price swings. One way to solve for volatility risk in payments is for the payments provider to guarantee an exchange rate at the onset of a transaction. Take Ripple's payment solution as an example. Should the price of any given cryptocurrency or digital asset change during the 3 to 5 seconds it takes a payment to settle, Ripple automatically absorbs that change and the customer is unaffected. Other primary risks associated with crypto for payments are around regulations either being unclear, 42%, or highly restrictive, 41%. This is in line with other research we have conducted where regulatory clarity was the single most cited barrier to adoption of crypto-enabled payments. Close. When it comes to crypto-enabled payments, it's no longer a question of if, but when for financial institutions, enterprises, and their customers. Whether for internal treasury, lending/borrowing, accepting donations, or payroll and distribution, there aren't many areas where crypto isn't currently being used for payments or will be in the near term. In order for multinationals to retain customers, grow revenue, and gain a competitive edge in today's always-on economy, they need access to seamless, more cost-effective cross-border payments and real-time settlement. Ideally, these solutions can address and protect against key pain points like costly payments and high interest rates, and provide access to greater liquidity in new markets to allow their customers to grow and scale. While solutions providers can certainly offer faster, better ways of moving value, more widespread global adoption of crypto for payments hinges on regulatory clarity. Promisingly, progress has been made in many countries and regions around the world, including the UK, EU, UAE, Japan, Mauritius, and Switzerland. At the country or union level, governments and policymakers must continue to come together and agree on a clear path forward for how and when to regulate crypto. Without it, we are inadvertently stifling further progress and innovation. Hint, 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 SEC. No, they didn't say that, I did. A note on compliance. While we didn't report on compliance as part of this year's study, it's a core component to the Internet of Value and ultimately paved the way for financial institutions and their enterprise customers to interact with crypto and DeFi. Therefore, we wanted to include a note on the current and future state of crypto compliance, barriers, and challenges within the current landscape, and what's on the horizon for financial compliance professionals. Compliance has been and continues to be a key issue for our financial institutions evaluating crypto and blockchain technology. It's estimated that the financial industry spends roughly $181 billion per year on financial crime compliance. If we learned anything from 2022, it's that the crypto industry needs clear compliance requirements. With all the varying rules and regulations for crypto companies to adhere to, KYC, AML, disaster recovery, sanctions, privacy, vendor risk and management, consumer compliance, etc., this begs the question, how can other companies entering this space navigate the ever-evolving compliance landscape? Current and future state. Financial crime compliance regulations are a moving target. According to a recent report from LexisNexis, over 50% of global payments executives at corporations and financial institutions think financial crime compliance is very challenging, and 16% say it's extremely challenging. As noted in the previous section, we also learned that most enterprise respondents plan to leverage crypto technology to enable customers to make and accept crypto payments. So as more and more companies adopt crypto, they will also be expected to navigate the various crypto compliance regulations, or lack thereof, in different jurisdictions, including if they need to comply, and if so, what they need to do in order to meet those requirements. This likelihood of more widespread adoption of crypto will undoubtedly demand clearer guidance and a more seamless compliance process. Barriers and challenges. The global compliance landscape today is highly fragmented and segregated, with different processes, timelines, and licensing requirements across jurisdictions. In fact, regulatory compliance is a top challenge for 66% of payments executives at leading corporations and financial institutions worldwide. Compounding this is the fact that the broader DeFi market is largely unregulated or subject to uncertainty, and major players like HSBC and BNY Mellon want to enter the crypto space but are treading lightly due to the uncertainty around DeFi protocols and where compliance fits into the equation. As we learned in other areas of our study, price volatility was the single most cited risk of using crypto for payments. In order to adopt institutional DeFi, financial institutions need to be protected from market volatility to help mitigate financial risk. And then it says $181 billion is estimated financial industry spend per year on financial crime compliance. Reprieve for compliance leaders. By pre-programming compliance rules, like Know Your Customer, KYC, anti-money laundering, AML, transaction monitoring, on-chain and off-chain, and sanction screening, blockchain has the power to reduce the risk of error and make it more cost-effective and easier to manage complex compliance requirements. In turn, this can help enable more financial institutions to offer an on-chain DeFi solution to their customers. Positive and progressive movements also came out of 2022, including on-chain compliance regulation and analytics firms gaining more attention with a few large investment rounds. And global legislation gained more positive traction in countries like Brazil, where Congress approved a bill to regulate the use of digital currencies for payments within the country, and Morocco, whose central bank is finalizing a crypto governance framework. Favorable crypto regulation is also expected to come soon from India, Germany, Australia, the UK, and others. Given broader trends of crypto regulation gaining traction, it appears that much welcomed reprieve is on the horizon for compliance professionals. Close. We believe the importance of these regulations and requirements will only increase as more assets are tokenized and more financial institutions begin incorporating crypto into their businesses, and customer demand for faster, better payments continues to rise. As crypto and blockchain continue to enter the mainstream and common misconceptions are cleared up, so too will compliance requirements and regulations. All right, conclusion. The vast majority of global finance decision makers, upwards of 88%, believe that crypto and blockchain technology will have either a significant or massive impact on business, finance, and society over the next 3 years, not over a decade, not down the road, but by 2026. Perhaps even more promising is the fact that 100% of respondents at financial institutions in roles related to innovation stated as much. While not surprising, given the nature of their particular job function, this only further cements crypto's promise within the broader financial sphere, which is ripe for innovation. Today's financial system is inefficient, opaque, and unfair, which has resulted in inaccessibility, inefficiencies, and high costs. More than 25% of the world's population lacks access to basic financial services. Cross-border transactions take days, if not weeks, to settle, and costs are orders of magnitude higher than they could be using blockchain and crypto technology. The total addressable market in finance use cases like lending and borrowing is in the dozens of trillions of dollars. With current institutional DeFi penetration of that market opportunity capturing less than 0.1%, finance is the single biggest field of untapped opportunity for blockchain technology. And while this past year saw the fall of major financial players like FTX, Three Arrows Capital, SVB, and others, it also experienced a rise in CBDC pilots, increased adoption of crypto-enabled payments, and the ever-evolving real-world utility of tokenization transcending industries. Even more, companies like Ripple are building solutions that bridge these technologies and their applications into holistic, interoperable solutions that are easy to integrate and simple to use. In doing so, organizations and their customers are able to interact with crypto and DeFi in a safe, secure, and compliant way, while simultaneously deepening customer engagement and brand loyalty, opening up additional revenue streams, and tapping into global markets and new opportunities. When we look back at where crypto and blockchain were a year ago and where we are today, given the accelerating pace of innovation and powerful signs of adoption, we can't help but agree that these technologies will have profound impact in the months and years to come. And with clear regulation and applicable compliance guidelines across jurisdictions, we will undoubtedly see newfound functionality and applications of the technology emerge. We will look forward to exploring those as we continue our work together building the Internet of Value. And then it has total addressable market in finance use cases like lending and borrowing is in the dozens of trillions of dollars, with current institutional DeFi penetration of the market opportunity capturing less than 0.1%. Finance is the single biggest field of untapped opportunity for blockchain technology. Then it's got a nice graphic here, the token life cycle in the Internet of Value. Tokenize and asset ownership rights of the asset are converted into a unique digital unit to represent its value on the blockchain. 80% plus global finance leaders think NFTs will have a big impact on trading tokenized assets like stocks and bonds, buying and selling real estate, derivatives, and carbon markets. $18 billion total market size of all tokenized assets. Then under manage, it says the token can then be used to trade, transfer ownership, make a payment, lend, borrow, etc. via an exchange or marketplace leveraging DeFi protocols. $50 billion plus of total DeFi market cap in February 2023. 66% enterprise finance leaders are familiar with using DeFi to trade, borrow, or lend tokenized real-world assets. And then under move, with increased liquidity, the token's value can be used as a form of digital currency and moved around the world in real time 24/7, 365. $250 trillion is expected in cross-border payments value by 2027. I'm not sure I heard that statistic before. So that's basically it. That's our report. The rest are just end notes. So we made it through the whole report. If you listen to the whole thing, congratulations, you're a champ and a certifiable cryptoholic like me. So that's great. I hope you learned a lot. I'm going to try to go through this and put in some quotes out on my Twitter page just to pull out some of the astounding statistics that were in here and the good news and the confidence that was in this report, because after reading it, I think what I see is just, first of all, a focus on the next 3 years specifically. So that's our next crypto cycle, which makes sense that we have 3 years of really strong adoption ahead of us. Secondly, that Ripple is perfectly positioned to take advantage of that, which we already know. And thirdly, that they're further along in this process than they've really talked about and led us to believe. That is, treasuries and financial institutions and even enterprise businesses who are using crypto or planning to use crypto in their business. So I think the whole shift in the Internet of Value is solidly underway, and the next 3 years are just going to be really exciting to be a part of. So we're lucky to be here early, and lucky, or maybe we just did good research to get here. But nonetheless, this was a great report, and thank you for listening, and I will post it on my YouTube channel. If you want to find me on Twitter, I'm at Linda P. Jones. Check out my website at lindapjones.com, and please subscribe, like, and share the video. That's all for today. Until next time, live the good life and be wealthy and smart.